Rashesh Shah, Chairman and CEO of Edelweiss Financial Services. Rashesh, good afternoon to you. You know, most of what the Reserve Bank today said was on expected lines, one might say, and the market seemed to have not reacted to it in any big way, because if we did see minor gains in the first half, we've seen a bit of a sell-off in the second half. What are you taking away from what's happened today?
Yeah, I think the good news was, as you said, it was along expected, what the market has already factored in. And I think one of the good things the Reserve Bank has been doing is being very consistent in its approach towards inflation. And they've been very clear that they are not going to get swayed by short-term changes because of the base effect or not. The RBI governor has been constantly saying that until he feels that the structural inflation has come down, and we have effectively won the war on inflation, there is no way interest rates will come down. And I think that has been increasingly factored in by the markets. And what has also happened, given the events of the last few quarters, the interest rate and RBI policy is not such a big catalyst anymore. There have been other catalysts that have got created as things have changed in the last few months. So I think RBI policy, as long as there is nothing unexpected, there isn't anything that shocks anybody, will not spook the markets, nor will it, even encourage the markets, unless suddenly RBI has a view that inflation war has been won and we can now start easing off.
You know, Rashesh, I just want to ask you a supplementary question to that. I know what you mean, I get what you mean by saying that this inflation and therefore interest rate conversation is not having a dramatic impact on the market. But the other monetary policy angle we need to keep an eye on is how the RBI is positioning itself in the face of a withdrawal from the Fed, or the beginning of the Fed interest rate, sort of hike cycle next year. So is there anything that you would take away either from today or the way you see markets sort of position themselves in the coming months on that aspect of monetary policy as well?
I think on that aspect, what RBI has been doing for the last few months has been very good. They've increased the reserves, they've been buying US dollars. Otherwise, if you see the kind of inflows that were coming in and the kind of global liquidity that has been there, we would have all expected that the rupee would have appreciated a lot more. But the fact is, RBI has intervened very consciously, very aggressively to ensure that they didn't allow the rupee to appreciate, which would have affected exports. But actually, more importantly, they have also amassed quite a bit of reserves. And if you see, RBI, as in the last couple of years, has have a twin approach. The one approach is around liquidity and the other is around interest rates. And what we have seen is their approach to liquidity is largely determined by their view on the currency. So when currency has been under threat about a year ago, when the Indian rupee was falling very sharply, RBI had actually tightened the liquidity a lot. But in the last 8-9 months, RBI has been very easy on liquidity. So if you see, currently liquidity conditions in Indian economy are fairly good, which just shows that RBI seems to be a lot more confident on the currency front. On the interest rate front, RBI has been driven by inflation. So interest rates are more correlated for RBI with inflation expectations, and currency and the liquidity is more correlated with currency for RBI.
Would it be fair to say, Rashesh, that you have no hope of a rate cut, at least in this fiscal now?
I don't think so. I think if you see the RBI commentary also, they expect that inflation will start inching up again as the base effect starts petering out. And it does seem that RBI feels that structural inflation, which is largely supply side driven, is not going to ease off in a hurry. And as long as that does not happen, unless there are some really extreme circumstances, RBI has been fairly clear that they will not cut interest rates. So I would see another couple of quarters, at least until March. It's unlikely that investors should expect any interest rate cut. But the good news on inflation is it is inching down, and I am at least hopeful that the inflation issue is coming under control, and maybe in the next 2 quarters, as the economy starts doing well and the supply side improves, we should see inflation coming under control.
Okay, so Rashesh, from here on, what's the trajectory for the market? Because we're going to have a scenario in which the dollar is rising, and at some point Fed will start to raise rates, and this really has been a liquidity driven rally, as we all know. From here on, Do you sense that there could be some pressure on the market because of lower liquidity?
I think there has been a little bit in the last few weeks, but as I said earlier, the global liquidity has eased off a little bit, but the Indian liquidity is still very good. So I think our onshore liquidity is still fairly strong, and what we have seen in the last few months has been, for the first time, there was flows from FIIs and the local institutions. Even now when we talk to mutual funds and insurance companies, the inflows and allocations to equities are only going up. So we are seeing, for at least for a change, that Indian liquidity is also driving the markets. It's not just the international liquidity. But as you correctly said, I think concerns around international liquidity are there, and they will always be there. They will continue to be there. But fortunately, vis-a-vis the Fed, it is expected that the ECB is going to be, easing off liquidity, pumping a lot more money. So that will in a way counterbalance it, and partly it will get counterbalanced by the Indian liquidity also. Also, as I said earlier, there are other catalysts that now investors are starting to focus on, and outside of liquidity. And in our conversation with a lot of global investors, I think there are three things they are currently a lot more focused on. The first one has been reforms from the government. Now I think over the next 5-6 months, at least after the state elections are over, a lot of investors expect that some reforms on the economic front will start coming out. The government will start acting on that. So I think that is the first catalyst that the investors are going to watch for, and that will affect the market.
Rashesh, let's talk about that, because so far, to be fair, we haven't seen any, from market's point of view. And if you're saying that post-elections we would see reforms, would that be the 2 or 3 month window? In which case, if something doesn't happen in those 2-3 months, would there be significant room for disappointment for market?
I think there could be some room, but as you see, I wouldn't say that there have been no reforms. I think the new government has acted, but I think there are two things the government was expected to do. The first one was incremental, improvement, incremental efficiency, get a lot of the decision making and the galvanizing the economy and the industry and the bureaucracy and all that. I think on that front, I think we should give full marks to the government. They have given confidence to the Indian economy. Optimism is high. There is a lot of incremental, gradual improvement in the functioning of the government that has happened. So that was expectation number one. The second was some big, structural reforms, really, on FDI, on GST and all of that. And on that, I think, the expectations have not yet been met. And a lot of people are expecting that post-election, hopefully, we will see a few of those. So I think government has done half the job, the other half investors are still expecting.
How would you, Rashesh, link what the government needs to do, and it's a long list and it's a familiar list already, and the upside you see in corporate earnings in the quarters to come, right? So if we aren't going to see anything concrete in the next quarter, so to speak, you're writing off then the October, November, December quarter. Let's assume that the government's big intentions, announcements come in only in the budget next year, which is Feb, so the Jan-Feb, March quarter is gone as well. So would it then be that you would turn down your expectations from this fiscal year's earnings and now only position maybe slightly higher expectations for the next fiscal year?
True. I think, the incremental improvement that the government has been doing will affect the current year, FY15. And in that, most people believe that economy, which was at about 5% GDP growth rate, will go to 6.5, and consequently the corporate earnings will also be going up only so much more. What we are seeing is most investors are not unduly focused on FY15 earnings, because a lot of them know that FY15 credit growth is not going to be much. The investment cycle has not started.
Rashesh, do you expect that FY15 earnings will in fact be even more disappointing than expected? I'm not saying that. I'm sure everybody is now only talking about FY16 earnings. I'm saying because if your suspicion is that FY15 will be far more disappointing, and that any impact of the good announcements made in the budget, if there are any, will only come in with a lag, then you want to start revising down even FY16, or is it too early to say so?
I think FY15, even now, what we have seen is, I haven't seen all the brokerage earnings estimate, but I can talk about our estimate. They are not very aggressive, so I think they will get met. There won't be a lot of positive surprise on that, because outside of a few industries like infra and the power sector, a lot of other ones are still doing well. I think the private sector banks, FMCG, IT companies, all of them are still as per expectation. There has not been a big change on that. So I don't think there will be a lot of disappointment, and most of the people have looked at FY15 as a 6% GDP growth rate and the correlated earnings vis-a-vis that. So I would say it would be more like FY15 will be somewhere around expectations, no big positive surprise in FY15, but absolutely what you're saying is correct. FY16 is where a lot of investors would look at significant growth in corporate earnings. In fact, the second catalyst after government reforms will be the view on earnings, corporate earnings for FY16, and that also a lot of investors are going to watch very closely as we go along.
Indeed. So Rashesh, if you have to put incremental money, what do? Do you invest in, say, IT and pharma, which have been trading at lifetime highs, and where earnings are likely to be good, quite good actually this quarter as well, or would you go with stocks like, say, banks or the likes of L&T, which have corrected about 10 to 15% in the last 1 month, and where earnings might still be a bit of a problem in the near term?
I think it should be a function of portfolio allocation, and if you are looking at a 3-year view, we do believe that I think a lot of the smart investors will put half the money in IT and pharma because the growth story is still intact. As long as the US is doing well, all these companies will continue to do well, and as we have seen that RBI will keep rupee in a very competitive range. So IT pharma will end up being about half of the portfolio, and I'm talking about investor who has a 3 to 5 year view, and the other half will be in things like Indian private sector banks. I think auto is coming back, and we are seeing a lot of investors also looking at auto very closely again. And then I think selectively a lot of the Midcap companies which have started now showing good quality earnings growth, which are not largely dependent on either capital or government policies, they have started doing well. So I think investors will continue this kind of approach to portfolio allocation.
Which mid-cap companies are these that you might be referring to, Rashesh, or at least the sectors that you're referring to?
I think they've been across the board. They've been very well managed, especially in manufacturing, because one of the things we have seen is last 3-4 years there is not a lot of fresh manufacturing capacity that has come on stream, and as a result of that, a lot of the existing companies which are good, efficiently managed, well capitalized. I mean, they are from from building materials to auto ancillaries, and we are seeing a lot of those companies which are now starting to get the advantage, because for the last 3-4 years no fresh capacity has come up in India, and it is expected that for next couple of years no fresh capacity is going to come. So the existing manufacturing companies, the existing players who are efficient, well capitalized, and fairly well managed, we are seeing, I mean, as you would have seen, stocks after stocks, companies in the range of the market cap between 1,000 crores to 5,000 crores, a lot of them are still doing well, and we have seen still a lot of appetite for blocks from investors, both the Indian and the foreign investors who want to buy blocks into these companies.
Rashesh, I know you prefer not to give us near-term targets or near-term expectations on either the headline indices or sectors, but I've got to ask you this question this way. If I was a retail investor, it took me a long time to believe that this market is going to continue to move up, that this is the beginning of the mother of all bull runs. So if I entered the market, let's say a month or two ago, and the last month or two, I've seen nothing but indecision in this market, so to speak, if I may say that. So now I'm a little confused as to what should I do. Should I continue to put more money in? Should I stay where I am right now? Should I get out maybe and re-enter at a time when markets might even go further lower in the next quarter or two? What would your view be for that investor who's a little puzzled right now, saying, look, is this supposed to be the mother of all bull runs? Because the last 2-3 weeks don't seem to indicate that.
True, and I think I must clarify, the reason I don't like to give short-term targets is frankly, you have no idea what is going to happen in the next couple of months. You can only look at the longer-term trend, and I do believe that I think a 5 to 10% correction, even in a secular bull market, happens any time for any reason, either global liquidity or some local events and all that. So investors should always be prepared. I think even if you invested in the last couple of months, investor is not so worse off because the market has gone sideways. And you should always remember there will be 3 or 4 months in a year where all the returns for the year are actually made for the investor. So if you will spend 8-9 months in a year where the markets are not going anywhere, and 3-4 months where all the returns will be made. Unfortunately, you can't anticipate which those 3-4 months are. And
so have we already done the gains for this calendar year?
I think if you ask me, we would expect that the next 3-4 months the market will still be in a sideways zone, but it is not equally true for individual stocks, because in spite of that a lot of individual stocks could end up doing well. So I would think for the next 3-4 months, and as I said, the 3 catalysts that now investors are watching, and that is going to drive the markets, the future growth in the market is going to be the inflation front and basically the entire macroeconomic outlook, which is improving, but I think investors are waiting for next 3-4 months, the corporate earnings expectation for FY16 and some reforms from the government. Any of these 3 will drive the markets, but I think for that, at least until for the next 3-4 months, the market may be sideways, and then anything happening in any of these 3 catalytic factors should affect the markets going forward.
All right, Rashesh, we appreciate you joining us today, talking us through the monetary policy impact on markets and the markets for the next 3 or 4 months as well. Thanks very much for your time. We're going to move to the other big story.